Hey guys, Max here, and yesterday was a little bit of an odd day for the markets. It was, of course, Easter weekend and a 4-day weekend in some places. So in the UK and in the rest of Europe as well, markets were closed from Friday to Monday, but in the US they were, of course, open, so there was plenty to talk about. Now the markets themselves, what actually happened? Well, US equities that were open didn't perform brilliantly and they struggled a bit at the end of the day. The S&P 500 fell by about 0.1%, so nothing major by any means, but not exactly stellar news either. Some old world industries struggled a little bit too, like healthcare, industrials and consumer defensives as you can see, while semiconductors and financials did a tad bit better. Tech as a whole didn't really see any major gains either. The Nasdaq moved mostly in line with the rest of the markets, falling by just over 0.1% for the day. Now bonds continued their sell-off with prices falling and yields rising. German bond yields have now risen to their highest levels in 7 years, and most other bonds are seeing similar highs as well. In the US bond markets, investors are really looking forward to hearing from some Federal Reserve officials over the rest of this week. The big question is again about how much interest rates will be risen by, either 0.5% or 0.25%, but there is actually a very small chance we see a 0.75% interest rate hike given how inflation last month was 1.2%. Let's remember that interest rates rising by any less than that number means that once more, interest rates in real terms are still decreasing every single month, not increasing, so no, the Fed isn't actually tackling inflation to any meaningful degree. US 10-year Treasury yields rose once again to another new high for the last few years. Now they're sitting at 2.86%. US corporate debt, the highest rated stuff, is now above a 4% yield, which means the best companies in the world are now having to borrow at rates far higher than they're used to. This is hugely influential and it will trickle down to the rest of the world too. Get ready to see a business environment where growth comes much more slowly, much more cautiously as the capital markets are changing and not for the better. Once again, US dollars continue to strengthen against pretty much everything, once more defying expectations. The yen has now seen its worst run in over 50 years. Its value has been dropping consistently and it's not doing well at all. The pound is back down to $1.30 and the euro is doing poorly too at $1.07. As for oil prices, things are back to looking bad after having a week or so of things doing quite well. Prices were falling across the board, which was nice to see. Oil price spikes are very frequently a cause of a recession, and with everything else looking so poor right now, seeing oil prices fall back down was really bullish to some investors. That ended though, obviously. Prices have now risen again, and right now WTI crude oil is sitting at $108 a barrel, and Brent crude oil is sitting at $112 a barrel. Part of this is the usual supply and demand toing and froing, but one specific shock is that Libya has had to shut down its largest oil production hub as a political crisis in the country looms. This is worrying for global supply. Libya is quite a big player, and it isn't completely clear when these protests will end and things in Libya will go back to normal. Gold has now continued to rise too, as we've been saying it would on this channel. Right now, gold per ounce is sitting at about $1,980, closing in on that $2,000 mark. Now, in the world of crypto, the 4-day weekend did not go amiss, and it was volatile to say the least, as markets were of course open. As for right now, the market is mostly where it started actually, with Bitcoin sitting closer to $41,000 than $40,000, and Ethereum sitting at about $30,000. There was a little flash crash where Bitcoin fell to about the $38,000 mark and Ethereum fell to the $2,800 mark. The altcoin market moved like that too, falling about 10% that day before last, almost out of nowhere, and again not on any specific news, only to then slowly rise back up to where it left off. Now last night we did get news that the fighting in Donbass in eastern Ukraine has started again. It's growing in its intensity. This has been expected for a few weeks now, though we really didn't know exactly when it was going to be, but now we have that answer. Loads of missiles were fired and we started getting reports that Russian forces had started advancing. This has been the next important stage in the war. No one really knows how it's going to go, just like we didn't know 8 weeks ago when the war started how it would turn out. But the consensus is that Ukraine is probably going to hold its own, but this isn't guaranteed. Russian logistical issues seem to not really have been solved entirely. Russian morale on the soldiers is reportedly very poor. Mariupol is still defended by some incredibly well-trained and well-motivated troops who are still inflicting very heavy casualties against Russia. The Russian Navy is almost, not quite, but again, almost a non-factor now, as when the flagship was sunk, it highlighted the vulnerability of the Russian fleet, and so that fleet is going to have to stay further afield and be less influential. On the other side of things, Russia has the initiative because it is the attacking force. They've had some time to recoup and likely stockpile munitions and other supplies, so maybe their logistical state will be better, and the Russian state itself seems more sure than ever that this war is going to continue. And actually, the public opinion from Russians back home in the country and not at war itself is heavily in support of this war too, to many people's surprise. How will this affect markets then? Well, it will depend on how the new fighting goes, to be honest. If Ukraine holds off Russia's advances and even forces them back and retakes the initiative, I'd suspect the end of the war would be in sight and markets might rejoice. If Ukraine and Russia go head to head, each losing thousands of men and showing no sign of slowing, the markets won't be as happy, as neither side is willing to negotiate or pull back for the most part. If Russia wins decisively, that could spell the end of the war altogether and the turmoil that it's caused. Countries like Germany, for example, would be very happy, as tensions would probably slowly normalize over time, and eventually gas and oil would flow freely once more into Europe and the markets would be happy. The chances of that are not a sure thing though. If Russia continues to devolve into genocide, kidnapping of children and the erasure of Ukrainian identity, then maybe the world will stay angry and nothing will change. Really, as usual, we just have to wait and see for a little bit, watch how the fighting unfolds and watch how the market responds to it. Now, economists are officially predicting that the United Kingdom, my home, will see negative growth throughout Q2 of 2022 as inflation has spiked up very high, energy prices exploded, and people are not feeling good here at all. The reason this is so important is because this has nothing to do with COVID. We've had negative quarters recently, but it's always been due to lockdowns, to businesses being forced to close against their will, and things like that. This would probably be the start of a very real recession, and before 2023 as well, far earlier than most people thought. The Bank of England has already been raising interest rates, hiking them up, but if a recession really does break out so soon, we can probably expect that to change and for those rates to be dropped again. This is sort of a precursor to what is likely to happen in the US, America being a little bit less influenced by global energy prices as most of what is used in the US is made there, but the long-term broad-based effects are the same. A recession is coming, without a doubt. It can't be stopped. It's going to be worldwide, and most people are just burying their heads in the sand. Russia, as a matter of fact on this topic, is also extremely likely to enter a recession soon. Basically, as soon as we get the data, this quarter will probably see a 5% decline in Russian GDP or something to that effect. Mainland Europe also is going to see a recession too. Many countries have inflation far higher than the UK or the US. The Netherlands, for example, is sitting at 12% inflation right now. Please just pay attention to this, live within your means, don't go out and finance a $100,000 car or buy a house that you can't afford right now. It's just such a bad idea in this economic climate. If you enjoyed this video, then make sure to like, comment and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that can help you protect your portfolio against inflation through fractional shares of art from world famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets on the brink as they are. It's completely free to sign up, so make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get over 7% interest on stablecoins to protect your hard-earned cash from being eaten away by inflation. Thank you all for watching. Stay stoic. Until next time.